I'm constantly looking for investment vehicles that give me higher income from equities as part of my enhanced equity income strategy. I'm in the living off my nest egg stage as a early retiree. So when I first heard about QDPL, I was a little bit mystified, surprised, skeptical, because the stated objective of QDPL is S&P 500 level quality and total performance, along with 4 times the income of the S&P 500. So a seemingly very difficult, if not impossible, objective to accomplish. But when I dug into it, it seems to have passed rather well through my filter. And that is why I own it and I want to share what I found with those of you who are pursuing the same journey. Let's cover some basics related to QDPL. QDPL actually stands for quadruple, meaning 4 times the income of the S&P 500 while moving about 87 to 88% in tandem with the S&P 500. So that's the stated strategy and the outcome that Pacer, which is the company that provides the fund, is aiming for. And that's what we're going to look at. So the fund's name is a mouthful. Pacer Metaurus US Large Cap Dividend Multiplier 400 ETF. It's the strategy execution is outsourced to Metaurus. We'll talk about that later. Usually outsourcing is not a good idea. In this case, I think it is, but we'll cover that later. Assets under management are 446 million, close to half a billion. So good size, more than adequate liquidity. Came into creation just over 3 years ago, does yield 5.71% approximately, slightly more than 4 times the S&P 500, has an expense ratio of 60 basis points. I consider somewhere in the range of 35 to 45 basis points for these type of funds to be more appropriate. So it's a bit on the steep side. I compared it against SPY, the granddaddy S&P 500 index, and it's apples to apples from the inception date of QDPL. And you can see from the chart that there's very little differentiation in terms of price movement. So the moving in tandem at about 87 to 88% with SPY seems to be holding. That's one data point that comes out. The second data point is that the total return is marginal, not material. It's just less than maybe 200 basis points or so. The average annual total return is about 70, 80, 90 basis points per year, on the borderline between marginal and the low end of material. More than adequate in terms of performance as far as I'm concerned. And the Sortino ratio, which is sharp, but only for downside. And the idea behind Sortino is that negative movements in price impact investors much more than positive movements. So it only looks at movement downwards. They're both at 0.39. So there's no difference there. But in terms of standard deviation, SPY has a higher standard deviation by more than 200 basis points. So you would expect that because anything that provides a little bit more income should have lower volatility. So lower obviously is better. So in conclusion on this page, more than adequate total performance, total return, and good income, and slightly lower volatility. So at the outset, it looks like QDPL is kind of meeting its stated objectives at a very superficial level. Let's discuss the strategy. So the objective, once more, is S&P 500 level performance for the most part, along with 4 times the income. So that's the objective. The strategy is, in my view, one of a kind. It's not the traditional covered call type of strategy, which characterizes the higher income from equities approach. What these guys are doing is they um, unbundle the S&P 500. And this is the part I didn't understand, that the S&P 500 can be broken down into price and dividends. So what they do is they take 100% of the uh, S&P 500 index along with the normal dividends that the S&P 500 companies give. So that's what that first chart on the left is showing. They then take 13% of it, so 87% of it, of the holdings or assets that they have, are kept in the actual underlying companies that make up the S&P 500. I'll cover it more when I cover the holdings. And they take the other 13%, and in the futures market, they buy 4x the dividend. So that's how they get 4 times the income. So there's a market for S&P 500 dividend futures, and they're typically institutions on both sides of the trade. And dividend futures are exchange traded, cash settled futures contracts. And you can go 1 year out, 2 years out, 3 years out, and so on. And the heart of the strategy is that there is a dividend risk premium, which I will describe. But essentially, what that means is that when you buy the dividend, let's say 3 years out in particular, the price that you pay is less than the actual return that you get, meaning you almost always make a gain. And I will try to explain how that works and to even quantify how much that gain is. So this almost seems like a permanent arbitrage opportunity. So to summarize, what these folks are doing is, instead of just owning the index, they break it out into two chunks. 87% of it is in the underlying companies, and 13% of it is used to buy dividend futures 3 years out. And that's how they make 4 times the income, with most of the improvement of the most of the performance of the S&P 500. So let's take a look at the holdings which are available on the Pacer website. So what I noticed was it consisted of three parts. 87% of the value of the ETF, the 446 million or so, was held in companies directly. So they don't own it via an ETF like IVV or VOO. They actually own the companies directly, and they're in this, at the same weight as in the S&P 500. So that portion of the ETF has uncapped growth. There's no covered call on it, and so on and so forth. So that moves up and down exactly as the S&P 500 does. Then I think they're going short is the only conclusion I can come to. At about 13% is a short position on three futures contracts, and they're 3 years out: 24, 25, and December 26. So they always are out, looking out 3 years out. And the market is more and more inefficient the further out you go, and that inefficiency accrues to the buyer of those contracts, which in this case is QDPL. And so because they're going short, they have cash, which is primarily the difference between the 100% and the 87%. And you take out some amount for the actual futures contracts themselves, and that cash is kept aside to resolve the contracts, and it earns interest during the time of the future contracts. So basically, as far as I'm concerned, I saw 4 different ways that made up total return for QDPL. There's obviously capital gains on the underlying companies, the 87%. Then the dividends paid by the 87% holdings that are made up of companies. Then there are the futures dividends, the dividends that you have contracted for, and then the interest on the cash that you're holding. So that, in a summary, is the holdings of QDPL. One of the salient features of the strategy is that dividend future markets tend to be inefficient. So what the first chart is showing is the dotted line is the implied value of dividend futures. The solid red line is showing the actual dividends that were received. So that is a market efficiency which benefits QDPL because QDPL is buying those futures and realizing whatever the actual dividends actually are, right? So that's the market inefficiency. That market inefficiency has been studied in detail by a professor, Jules van Binsbergen, and you can see his presentations on YouTube. So here are some quantifiable data about what that inefficiency actually looks like. So in 2015, if you look at the 1 year out and 3 year out, so in 2015, the implied dividend growth was 3.76%, but you actually got 4.92%. So difference marginally not bad, better than a poke in the eye with a sharp stick. But look, go out 3 years out, right? The implied dividend growth that you're paying for, if you're QDPL, is 6.77%. And what are you actually getting? 25.1%, right? It's just under 4 times. That's a pretty big return and an unexpected one and a positive one. And that is a very, very good thing if you're a QDPL shareholder. One more positive thing about QDPL is that the distributions seem to be non-destructive return of capital. So what I did was I looked at the last 4 quarters of distribution, and in the table you can see the total distribution, what component of it was marked as return of capital and how much was ordinary income. And ordinary income obviously is highly tax inefficient. And the total distribution was $2.07, of which $1.74 were return of capital. So 84% of the distribution was return of capital. So what that does is you don't declare the 1.74 for the most part on your tax return, but it is reduced from your cost basis. So when you do sell it, you will pay the tax that 1.74, but you pay it as probably as capital gains. In my case, it doesn't matter because I have no intention of selling these assets. So I'm more than comfortable adding the 34 cents, which is ordinary income, to my taxes and paying the tax on that portion. So there's a certain tax efficiency. Please note, I'm not a tax expert. Consult your own tax advisor when you make a decision to buy instruments like this. I'm simply sharing with you my own experience, right? The yield is 5.47%. The yield on SPY, which is the S&P 500 index ETF, was 1.21. So that's a difference of about 452 basis points. So it's more, in other words, QDPL is more than meeting its 4 times the SPY income threshold. And in my book, if the net asset value remains the same or increases, it is not destructive return of capital, meaning they're not just simply returning my own money back to me and calling it income when it's actually a return of principal. So if the net asset value stays the same, it's non-destructive return of capital. I'll share how it has performed since I owned it, but the short version is that this so far there has been no destructive return of capital. This income is real. How do I expect QDPL to perform in different market scenarios? So if the market is treading water, neither going up or down, it should perform better due to the increased income. If it is heading downwards, it should perform better than the index, again because of increased income. If it increases but gradually over time, it should at least match performance in my view, because the income will make up for the difference in the gradual increase in the S&P. However, if it increases very rapidly then it will slightly underperform. And the key thing to note is that most market price increases come in sudden bursts. So this top line, the very dark green, is what will happen infrequently, but will make up the bulk of market gains. That is the reason that even though in 3 out of the 4 scenarios the ETF will perform as well, if not better, and the fourth one, when it really matters, there will be a slight underperformance, which is why in the long run, QDPL will always underperform ETFs like SPY and IVV and VOO marginally. So the reason to own it is income, frankly, without giving up too much total return. But do not kid yourselves that this is going to match S&P 500 performance. Some more ancillary facts about QDPL, which for the most part I view either positively or very positively. So the first thing is that there's no active stock selection. It's purely S&P 500 index based, and 87% of it is directly based on the S&P 500, and it owns the companies directly. And so you get all the movement up and down of the S&P 500, which frankly is the investment vehicle of choice for long-term investors. There's no use of leverage. So derivatives, yes, because futures are a derivative, but there's absolutely no use of leverage. So that's a very positive thing. Growth is not capped, which I think is phenomenal. And they use a sub-advisor called Metaurus. And these guys seem to be the architects of the strategy. Normally, I don't like sub-advisors and outsourcing of strategy. But in this particular case, Pacer has a bunch of different types of ETFs. So for this particular ETF, I'm glad that they went outside and bought that very specific piece of expertise. Here's how I would summarize my thoughts around QDPL. First, it's an S&P 500 based strategy. That's important because in my portfolio, I like to have the investment vehicles that I own be based on some index for the most part. So that's a very positive thing. The second thing is that again, for the most part, it more than meets its objective of moving 87% with the S&P with 4 times the income. And I showed that data earlier that there were very, very marginal differences in total return. And for over 3 years, they have been able to provide 4 times the income of the S&P 500. There seems to be a seemingly permanent arbitrage opportunity due to the way future market works. And typically, the inefficiency increases as you go further out. So the second and third year futures tend to be the most profitable. And since this is a repeatable process, it seems like a permanent arbitrage opportunity. Very similar in concept, not in principle, but in concept to the way SWAL, another holding that I have, works, because they have found a permanent arbitrage opportunity in the way VIX volatility contracts and contango works, where when you bet on mean reversion on VIX, it seems to work for the most part. The expense ratio is a bit on the higher side, but it's not outrageous. Outrageous would have been in the 90 basis points plus. So these guys are about 15 to 20 basis points more than I would want, but it hurts, but not enough to boycott them or anything like that. It passes my criteria for inclusion in the portfolio rather convincingly, because what I want is higher income and lower volatility, and I'm willing to trade total return a little bit, and those three are met in spades. I just did a quick comparison to 3 other S&P 500 based ETFs that are rather well known. It's all apples to apples, meaning it's from the inception date of the whichever ETF came later. So in the case of QDPL versus XYLD, it's from QDPL's inception date. And if you know about XYLD, which is an S&P 500 based ETF, they sell at the money calls, which is typically a rather poor strategy. And there's a 501 basis points annual difference in performance, which is very, very large. Um, the next one is JEPI. JEPI came into creation earlier. So this is again from QDPL's inception date. It's about a 244 basis points difference. JEPI is not fully based on the S&P 500. They own 100 stocks from within that index. So my holding of JEPI is more as a counterbalance to the S&P 500. So my holding it is for a different reason, but that is the performance difference. The third one is also a holding of mine, and this is from the inception date of SPY-I. And this was a little bit surprising to me, to be honest with you. The outperformance is about 640 basis points per year. The reason I'm holding SPYI is because of the distribution. It's considerably higher than QDPL. So in a good portfolio, you have multiple vehicles trying to pull in different ways towards a common objective. So I own JEPI and SPY-I, and I won't even dream of owning XYLD. I wanted to explain where QDPL fits in within my portfolio strategy. So the style of investing I practice is called enhanced equity income investing. That is getting more income from equities. And it actually consists of 6 tranches. And I'm going to go through them rather rapidly because I've described this in much greater detail in a different presentation that you can find on my channel. But the 6 tranches are dividend growth. And the key word here is ETFs that contain companies with a history of dividend growth, not high dividends, but dividend growth. And I've given examples. And the ones in green are ones I own. So I own SCHD, and the others are rather large, notable, very well accepted ETFs in that space. Then there is a covered call tranche that of ETFs that sell out of the money calls. And these the assets need to be based on an index in my portfolio. And so I'm giving you multiple examples of either actively managed ones like Devo and much more passively managed ones like SPY-I and others. Then there is a variation on the covered call one that is selling call spreads. And the only two that I'm aware of are SPY-T and QQQT. Then there is a second variation on covered calls where the ETFs only own one company. And this is from a company called Curve. And so the examples I'm giving are Goop is Google, AMZP is Amazon, and then there's Netflix, Apple, and Microsoft. They have 6. I happen to own 5 of them. They're all positions at 1%. So that's the second variation on covered calls. Then there are future-based strategies, which is what I've described in this particular presentation. The only example that I know of is QDPL. And then there are alternatives, which are away from anything having to do with equities directly, but alternatives. And the two that I have found is one going short volatility, and I own an ETF called SWOL. It's one of my better performers, maybe in the top 2. And then Maxi, which is my 1% holding in Bitcoin, and where it generates income. It has to, in order to be in my portfolio, it must generate income. So anything in green, I own. And essentially what this portfolio does is it gives me 2 different levels of diversification. One is based on the multiple indexes, the NASDAQ, the S&P 500, and then there are other indexes involved like Solactive, FANG, and then obviously Bitcoin, volatility. So those are different asset bases, if you will. And then the second is different strategies, right? So I'm not just going with only dividends or covered calls, but variations. So there are two different levels of dimensions of diversification, which I find comforting. So as we end the presentation, I want to summarize my interaction with QDPL in the interest of full disclosure. So one thing to keep in mind is that I'm in the living off nest egg phase of my life. There are only two phases of investing as I see it. That is building the nest egg, living off the nest egg. I'm in the second phase. So you got to keep that in mind because that's the prism through which I'm making decisions. And my strategy is to generate income from equities and not touch the principal, which is in marked contrast to the 4% rule, portfolio harvesting, and other strategies which may be viable or not viable, depending on your approach to how you see these things. I call my strategy enhanced income from equities. So QDPL is around 6% of my portfolio. The target is a minimum of 7.5%. And I hold it in both taxable and tax deferred accounts because of the 84% of returns being return of capital. So I find it to be, in my case, worth holding in a taxable account. It is my fourth largest position after SCHD, JEPQ, and JEPI. I initiated the position in October of 2023, which was about 2 years after I decided to move away from individual dividend growth companies that characterize my portfolio and into ETFs. I add to my position regularly. I'm a big believer in dollar cost averaging, and I do it every time I can get my hands on a few bucks. And my gains cumulatively from the time I've bought it on this asset is around 12.65%. So I've gotten in the range of around 6% to plus yield on cost on my holdings, and I'm sitting on 12.65% of unrealized capital gains. I believe, based on what I've shared and my own experience, that QDPL is a viable investment in both phases, accumulating wealth and living off of wealth. I hope you enjoyed this presentation. If you have suggestions for how I can do better, please make a note in a comment on this presentation. If you like the work, subscribe, and you can even give me ideas for other topics. I intend to create videos on every single one of my ETF holdings, and that's probably another 12 to 14 videos. Thank you for listening, and all the best in your investing journey.